Brace yourself. 7 powerful market signals are illuminating the current investment landscape, and not all of them are pointing in the same direction. Whether you're a cautious investor or thrive on bold bets, interpreting these indicators can be both enlightening and, yes, controversial. Ready for a whirlwind tour of what might shape your next big financial move? While I don't often focus on macroeconomic forecasts, mainly because, let's face it, it's nearly impossible to flawlessly project where interest rates, economic growth, or even inflation are heading. It's sometimes vital to step back for the big picture. Legendary investor Peter Lynch once joked, "If you spend 13 minutes a year on economics, you've wasted 10 minutes." Does he have a point, or are we ignoring signals at our peril? Still, periodically checking on some key economic barometers can provide helpful context. That's why I've just updated a revealing chart from Morningstar's Markets Observer, highlighting 7 important market metrics compared to their range over the last 2 decades. Intriguingly, 6 out of 7 metrics are now sitting near the top of their historical bands, potentially flashing a warning sign for prudent investors. But is this cause for alarm? Let's dive in and judge for ourselves. Gold. Current status. Exceptionally high, gold's recent surge has been nothing short of dramatic. Not only has it outperformed almost every other major asset over the past 20 years, but as of August 31st, 2025, it was also up over 31% for the year. What's fueling this? Central banks across the globe are stuffing their reserves with gold, turning away from the US dollar, a process many call de-dollarization. Meanwhile, anxious investors are piling in, searching. But here's where it gets controversial. Research by Campbell Harvey and Claude Erb points out that gold prices typically revert to their long-term average once they soar. Elevated gold prices today could easily set the stage for years of disappointing returns ahead, just like we saw post-1980 and again after the 2011 peak. Chasing gold at these heights is riskier than it looks. My view, max out gold exposure at 5% of your portfolio or less. And remember, the current boom likely isn't permanent. Would you agree, or do you think gold has more room to run? Federal funds rate. Current status, on the higher side. Even though we've seen a slight dip recently, short-term interest rates remain well above rock-bottom levels seen just a few years ago. After a long era of near-zero rates meant to invigorate the economy post-2008, the Federal Reserve has hiked aggressively since March 2022 to combat inflation. Now, even after cooling off a bit, rates for cash and short-term bonds still beat inflation by a comfortable margin. For example, as of September 19, 2025, a 3-month Treasury bill yields nearly 4% compared to an inflation rate of around 2.9%. This means short-term savers aren't losing purchasing power like they once did. Plus, compared to the ultra-low yields of the past, high-quality bonds are finally looking appealing again. Is this the best environment for fixed-income investing in years? Or do you sense another twist coming? U.S. market PE, price-earnings ratio. Current status. Quite elevated, domestic stocks have enjoyed an exceptional 2-decade run, only briefly derailed by a few short downturns. The price-earnings ratio on broad U.S. stock indices has more than doubled since the aftermath of the financial crisis, which means shares are definitely not cheap by historical standards. High valuations can persist if corporate profits keep up, but if growth falters, stock prices could give back some of these gains. Interestingly, not every corner of the U.S. market is prohibitively expensive. Areas like small-cap stocks, energy, healthcare, and real estate still offer relative bargains. And this is the part most people miss. Overseas equities continue to trade at lower valuations, despite healthy recent returns. Are U.S. stocks overvalued? Or is this justifiable optimism? Brent crude oil prices, current status, on the lower end. Oil prices have been a roller coaster, skyrocketing with China's industrial boom, plummeting during financial crises, and crashing again during the COVID-19 shock. Lately, prices have mostly sagged, hit by worries about slowing global demand and the move toward alternative energy. Add ongoing wars and geopolitical turmoil to the mix, and things only grow more uncertain. Interestingly, while some see this as a headwind, others spot opportunity. For those willing to weather volatility, a modest allocation to a diversified commodity fund, including energy, can help diversify and potentially hedge against inflation. But can this strategy truly protect portfolios? Or is it just chasing the ghosts of past oil booms? Bitcoin, current status, riding high. Bitcoin's wild journey is nothing short of legendary. From mere cents in 2010 to edging close to $123,000 by late 2025, its returns have trounced every other asset. But here's the catch. Bitcoin's price swings can be brutal, plunging by as much as 75% during previous crashes. With speculative fervor driving much of the activity and no fundamental cash flows to anchor prices, caution is essential for newcomers. Is now a good time to get in? Or is this hype set to cool like past crypto winters? US dollar index. Current status, still robust, but slipping. For much of the past decade, the US dollar looked unstoppable, thanks to a mix of global turmoil, American growth, and the greenback's reserve currency status. But recent months have signaled a reversal, with the dollar dipping about 7% in 2025 alone. What's behind the shift? Many central banks are diversifying away from dollars. The U.S. government's ballooning debt is a growing concern. And expectations of further interest rate cuts could dampen demand for greenbacks. For investors, this highlights the importance of holding some assets not tied to the dollar, like international stocks with unhedged currency exposure. Should U.S. investors be rethinking their dollar-heavy portfolios, or is this just noise? U.S. real housing price, current status, record highs. Here's where things really get polarizing. Inflation-adjusted U.S. home prices have rebounded since the last recession and now hover near all-time peaks. Older homeowners may be sitting on a substantial nest egg. Selling, downsizing, or even tapping home equity could free up cash for retirement. However, younger buyers face daunting affordability barriers, often forced to settle for smaller homes or continue renting while saving up. Even for retirees, the choices aren't simple. Home equity loans and reverse mortgages can be costly and complicated. Meanwhile, younger families may feel boxed out entirely, sparking intense debate over the long-term health of the